Good morning, everybody. Welcome back to the Opportunistic Trader. We have a special guest joining us today, all the way from Australia, where it is right now 12:30 a.m. On Friday, I guess. We have Gary Holland from the Heuristic Fund. Gary focuses on technical analysis and a lot of interesting indicators on Bollinger Bands, RSI, overbought, oversold markets. Really has some fascinating stuff. And so, Gary, thanks for joining us.
Well, thanks for having me, Mike. Yeah, so it's morning there and it's morning here, but a bit darker outside.
Yeah, thanks for staying up till the wee hours to talk to us. This is the first time you've been providing some information in the chat room, but this is the first time we're speaking to you, so I figured it would be helpful if you could let everybody know a little bit about yourself, your background.
Okay, yeah, well, so I started the markets back in the early 80s.
Hey, Gary, speak a little closer to the mic.
Sorry. Yeah, I started down on the futures floor in Sydney back in the early 80s. One of the local brokers in Sydney, and then moved on to another local broker for about 10 years until the late 90s. And then after that was at Citibank for 8 years. And then after that, Morgan Stanley for 3 years. And then my most recent employer before I left to do my own thing was Societe Generale, and I was there for just over 10. And then over the last 14 months, I've been trading my own money, testing some strategies, and on Monday I start trading some outside money that I've gotten here in a unit trust. I don't know if you have those in the US, but we have them here in Australia. People buy units in a trust for a certain amount of money, and then the units either go up or down depending on the net asset value of the fund. So,
just wondering, I didn't want to jump into it there, but just wondering, can you take us through how's that different from a hedge fund?
Think about that. It's about the same, but the structure's a little bit different. With the unit trust, I have to distribute all of the profits before the end of the financial year. So the unit trust cannot hold profits. So at the end of every 12 months, all the profits have to have been distributed to the unit holders. I guess that'd be one big difference. You can distribute profits whenever you want. Most people do it either semi-annually or annually. I'm doing it quarterly because I've got some people that want it that way. Unit trusts aren't used that much in the financial market space, but they're used a very lot here in Australia for trading in real estate. So real estate investment trusts, or REITs as they're called down here in Australia.
And is that mainly due to regulation in Australia versus other parts of the world, like the US, for example?
Yeah. And also, you really need an Australian financial services license to do what I'm doing. But as long as you don't have more than, say, $2 million of retail money, and the rest could be wholesale money, there is a way that you can set up a unit trust and not have to go and get one of those licenses, which cost you about 50 or 60 grand, which would be a bit onerous for someone starting off like myself. So, if you're selling your fund to wholesale people, which I've done, then if you get retail money, you can only take up to a limit of 2 mil.
Interesting. So,
yeah.
It sounds like you took us through a little bit about, you worked at Citigroup, Morgan Stanley, SocGen. You've worked at some of the biggest places in the business, especially in Australia. A lot of experience. You've been in the market for over 25 years. Take us through the way that you look at the markets.
Okay, well, I've been pretty much technically based ever since I started. Basically, ever since I remember if I was 14 or 15, I found this book about trading stocks, and they had some charts in there and chart patterns, and one of them was your good old favourite, the Head and Shoulders, and I started drawing charts on charting paper for various, cheap stocks in Australia. And one was a mining stock called Longreach. I still remember it. And yeah, when I was like 14 or 15, I put some money into it, made myself $800 in a week, and I thought, how good's this? So just using one of the chart patterns that they had in there, I think it might have been a reverse Head and Shoulders. But so ever since then, I've just been mainly interested in technical analysis. So then I went from there to using point and figure charts. Computers weren't as much used as they are today in order to get your charts up and running. It was really just daily charts, or you'd have a tick chart for the actual day of trading. That was all. You couldn't put like hourlies or 5 minutes with long histories on them.
Right.
So you pretty much had to do all your charts by hand back then. And then it wasn't until maybe the late 80s when you could, the mid to late 80s when you could actually get some better charts. And then I did a bit of Elliott wave, and then using RSIs and stochastics as well. Also, in the time I was at SocGen, I also had a lot of looking at sentiment indicators, like the daily sentiment index that's put out by Jake Bernstein daily, the commitment of traders, put call ratios on the S&P, that kind of thing. And the trading I'm doing now is basically looking at divergence between RSI and stochastics and price action, and then using a trend following model off of that when I get a signal from the divergence between the RSI and the stochastic. So
take me through that. What do you look for in terms of the divergence between the RSI and the stochastics?
Well, without giving away too much secret sauce,
give it all away.
Anyone who's looked at RSIs and stochastics, if you have them on the same page as the chart, if someone just had a quick look at it, they'd say, well, they just move pretty much in the same direction all the time, which is true. The majority of the time they do that. But every now and again, there'll be a time when they don't move as far as each other. So the stochastic might go from 90 down to 20, but the RSI won't go down as far. When you get divergences like that, it can be an indication of something. I won't say what. And then when I get those signals, I then go and look at a shorter term chart which has a channel breakout system on it. And then if the divergence is giving me a buy signal, I'll only look for if the channel is broken to the upside on the channel. And then I'll use the bottom part of the channel as a stop. So I look at 20 different markets over 6 different intraday time frames. And then the time frame I use to actually do the trading is shorter again.
Well, that's what I was going to ask you. What sort of time frame do you look at?
So the time frames I look at intraday are 15-minute, 30-minute, hourly, 90, 120-minute, 180-minute, and 240. And then the chart that if I get a signal from one of those, the chart I use the actual signal off is then just a 5-minute chart with a pretty basic channel breakout on it. I use a different length for the entry and a different length for the exit.
And are you mostly expressing these views in the futures market, or is it equities?
All futures. All futures.
Any options, or just futures?
No, you could use options. I haven't been able to do too much back testing on options, but mainly just the futures. So, not that I'd get much time decay because my trading's reasonably short term. Like a losing trade will be hours, a winning trade could be 3 or 4 days, like a couple I had late last week, early this week.
And so what sort of risk reward setups do you look for when you put on one of these trades? Because like you said, maybe a losing trade you're out pretty quick, but a winning trade maybe you're in for a few days. Is there a specific risk reward that you look for?
Okay, well, going back historically over all my trading, I put all these numbers together for the investors that I was talking to. What do we got here? I get 45. I got an average of 45% winners, so I lose more times than I win. But my winners are 3 times my losers. Yeah. So on the basis of that, just let me get the spreadsheet up here. Sorry, I didn't know we were going to go down this line of questioning, but here we are. Yeah. So off the basis of that. Sorry, just let me get this up here.
Yeah, I mean, it goes to show exactly what we've detailed. Whether you're at 40%, 50%, 60%, as long as you can let your winners run and they're significantly larger than your losers, and you continue to take trade after trade, that's the sort of thing that equals a positive year. And it's pretty interesting. It's not, nobody's making money 90% of the time, 80% of the time, 95% of the time. It's about being consistent and cutting your losers.
Yeah, well, that's right. So for the calendar year to date, I'm up well, including the month it's about to finish, I'm up 47%. That's risking 1%. That's risking a maximum of 1% of my funds under management on each trade. The average risk is usually around 0.8%. That's the risk when I'm getting in. So, yeah, as you say, like the combination of that money management and that system, you know, they're the kind of returns I'm getting. And as you say, like you don't, even with a system that wins 90% of the time, if you've got such a massive position on that 10% when it loses, you can still blow yourself up.
Sure. I mean, that goes down.
So,
If somebody has one of
management.
those 90% strategies, it's probably a selling vol strategy. And yeah, there are different times where, you know, those continue to clip coupons, and then, you know, you get one big move
Yeah.
and that covers that.
It's like picking up pennies in front of a steamroller, I think they say.
Yep, that's one of the sayings.
Yes, and so you know, you've got to trade in a way that you're comfortable with as well. So I've dabbled in a couple of little things, just testing stuff with mean reversion, which is what you were talking about, and it's just not my style. I can't handle that pressure of something going in a direction and me selling into it, because I think it's going to revert back to the mean. I'm more of a trend follower kind of person. You know, I want something that's going to give me odds. And in trend following, that's basically what you're getting. You're getting long optionality out of your trade. So you're risking small to hopefully make big. And even though, yeah, you'll be copping some losers, which is the negative side of being a trend following type of person, you know you're going to get runs of losses. I mean, that's a mental strength that you've got to have.
Well, since you're bringing up trend following, how do you differentiate from a typical trend follower? Because, you know, it's funny you bring up trend followers, because in January, trend followers had one of their best months ever, up over about 10% as an index. Like the SocGen Global Trend Index was up about 10%, and CTA Index had a great month. And then in February, they had one of their worst months, and then year to date they're down a few percent. They just haven't done that well. And you know, in January everything continued. Equities continued higher, energy markets continued, fixed income, and so everything lined up perfectly. But they've kind of struggled over the past decade, not being able to capitalize on some of the trends. How does your strategy and the way you look at the markets differentiate?
Yeah, so when you're talking about trend followers, and the vast majority of people talking about trend followers, they're talking about people who are trading off of, say, daily charts, for example, right? So they'll apply their, let's use something dumb like the turtle rules, for example, or a moving average, any of those big CTAs. Obviously, they've got their secret sauce as well, but they boil it down and they're breakout trades of some sort if they're a trend follower. They're trading off of longer term. So, some a CTA, I don't know, you could pick a name. There'd be average holding period of say 4 weeks for a trade, right? The winners they could hold for 6 months, the losers maybe for 4 or 5 days. So I have traded like that when I was at Morgan Stanley, but obviously they had Morgan Stanley's got a lot more money than I have, and in order to trade that way, the big picture trend following method like that, the size of the stops that you're using, even if you're only risking 1% or 2% of your funds under management, you still need to have a bit of money under management in order to be able to do that. So to start off trading with my own money, and considering that markets are fractal, that is, if I showed you a 5-minute chart and a daily chart and I didn't tell you which one was a 5-minute chart and a daily chart and it didn't have a scale on it, you might not be able to tell which one's which. Right. That is, the patterns are similar. I then adapted my trend following to the shorter term, so therefore my stops could be smaller, and and also my account size didn't have to be as large as it would be to trade those larger positions. So the CTAs you're talking about and the hedge funds who are trend followers, then they're trading on a bigger time frame than I am.
Yeah, absolutely. So I thought that we would maybe take, if you could take us through a few of your recent trades, and these are some of the trades that you've actually posted on the site, and kind of take us into what made you kind of take a look at these markets and what made you get these signals.
Okay. So, yeah, the ones I put on the site, I think the first one, First one was we're talking about S&P put call ratio, and also the commitment of traders was giving me a signal as well. So I've got that one set of trading style that I told you about with the intraday trading that way, the divergence between the RSI and the stochastics, and then using a short-term trend following model. And then with these sentiment kind of ones, that's like a slightly different account that I have, some money in it, that I also then trade the kind of things that I put on the website. So with this one on 18 June, the CBOE put call ratio 10-day moving average was up at similar levels to what it had been when we saw the February high, the early February, late January high in the S&P.
Right.
So in that piece that's attached to the site there, as I said, in that equity option traders are piling into calls relative to puts at a record pace, and I had that chart there. Chart shows the 10-day moving average equal to that seen at the January 26 all-time high. And at the same time, we had another sentiment indicator. That's the commitment of traders, which is provided by the CFTC. Showed the net positioning of small spec, which are retail traders, was also at record levels. But the vast majority of the buying having been done towards the end of this rally into 18 June. So I said in that piece that the combination of those two things meant that being long that market was risky. And the way I trade off of these sentiment indicators is that I put again, just a simple channel breakout model on an hourly chart on the market in question. And then in this case, I'm looking for the market to come away. I'll only look for a sell signal off of that channel breakout on an hourly chart.
And what about, how do you look to take profit once the trade is initiated?
I let it run until the channel breakout stops me out, because it keeps following the market, as you know.
Right.
So yeah, that was a pretty good trade. I think we saw the S&P. I didn't obviously catch all of it, but and I was looking at it, the market was at 27.85 and it got down to 26.93 10 days later, which is about 6 or 7 trading days later. So that was a pretty good one. The other one was on the 14th of August, looking at gold.
Yep, I brought that chart up.
Yeah, so that's another one I had on the site there. I said that trend followers, which on the commitment of traders site, if you get your commitment of traders data, they're the people on the commitment of traders that they call non-commercials or large speculators, or they might call them leveraged funds. Right. So the vast majority of those guys are CTAs or hedge funds.
Right.
What'll happen is that even though trend following, can be a profitable business, at major turns in the market, trend followers are usually positioned at their worst. That is, they have their largest position on. So that happened on that day, on the 14th of August, 2018, and also we'd seen the percentage bulls that's distributed by Jake Bernstein. The 21-day moving average on that was about at 11 or 11.5, which was almost a record. So I think on that piece there, I said, yeah, trend followers holding a record net short position as a percentage of open interest. We'd also seen a bit of a spit down out of a sideways going into that day. And yeah, since then the market, I think it spat off for about another day, and then it's turned around and rallied like $40 or something. Is that right?
Yeah, well, we traded down one day in the Asian session below 1170. I think we got 1160. I don't even know, around 1165. Then rebounded strong that day. I think we closed green on the day, back above like 1180. Then nearly got up to 1220 recently, and here we are at 1206, kind of back in the range.
Yeah, yeah. So, and then the third one was on the 16th of August in the dollar index, where I felt really strongly about that one. So I think I said in that piece there are too many traders on the bullish bus in the dollar index. Right. With sentiment being at record highs, it had hit 96%, which had only been seen before in late 2017 at that massive high up there at 104 or whatever it was in the dollar index. We'd also seen 4 consecutive days above 90% on the daily sentiment index. And from the back testing I've done on the dollar index, if you get 3 or 4 consecutive days in a row, that's usually a signal that there's too many people long. And also just putting a little bit of Elliott wave in there on the chart that I'd attached to your site. It looked like we'd put a 5-wave structure in up from the low in early 2018. And that's the reason I said we'd probably get back to 9,400, I think. So that was on the 18th of August. On the 16th of August, I think we've been down to 94.34. So that was quite a good signal as well.
Yeah, there's definitely been in the month of August. You're pointing out a few different things. We've actually had some good volatility this month, in emerging markets FX and G10 FX as well. Some moves. Euro went from about 116 down to 113, and got pretty much. We might have traded 118 or pretty close to 118 recently, and so it was a pretty good move. Oil, we traded down to $64, and now we're back at about 70. So there have been a lot of moves. On that note, what's on the radar right now? Like, what's piquing your interest on the technical side?
Okay, on the sentiment side, there's not too much at the moment. Like the percentage bull stuff, there's, let me get up the latest from yesterday. Nothing really too extreme at the moment. You've got crude, as of last night's close, was 87% bull. So really, I'd like to see those daily sentiment index, that Jake Bernstein sentiment index, either above 90 or below 10 before I'd even bother looking at it. And that's really only in, say, the financials and maybe crude. In commodities, I've found that when they get on a tear one way or another, they can have 6, 7, 8 readings at what are like max levels, and they just don't stop. So I'm not a big fan of using the Jake Bernstein sentiment index on commodities, but on the financials and say your crude and your gold and silver, they're very good. But there's nothing in any of those markets at the moment in that regard. On the commitment of traders stuff, you've got your 10-year notes are obviously at a record still. So that probably means that the downside will be limited at the moment. What else have I got? I think that's about it at the moment. On my shorter term system, I don't actually have any trades on at the moment. But I'd say the main thing with using sentiment indicators is that you need to be patient.
Well, that's what I was going to say. When you're using a lot of these sentiment indicators, they can say overbought and oversold for a long time. How do you actually determine? You said 90-10. That's the initial kind of piques your interest, but then from there, what other sort of filters do you use to help try to figure out the right time to get in or out?
So to start off with that percentage bulls daily sentiment index of Jake Bernstein's, above 90 and below 10, that's the first thing, right? Until that stage, it's not even worth looking at it. And then what I've done, I got all the data that they've had back from 1987 and in a spreadsheet, and you can buy it from them. It's not that expensive. And went through and back tested all the markets I was interested in to see how many consecutive above or below that 90-10 that you needed before you could be reasonably confident that you're going to get a turn. And markets have different characteristics. Like in the 10-year notes, for example, if you see one reading above 90, sell it, right? But on the downside, you need to see at least 3, probably 4 below 10 to be looking to be a buyer. But on the upside in TYs, above 90, it doesn't stay up there. If you see it above 90, that's usually that day, and then that's it. So different markets have different characteristics. Got to go back and do a bit of testing on those. Commitment of traders is a bit of a blunter tool, so that's probably not the sharpest tool to use, but that's definitely one when you see positioning very large one way or another, to then make you look at these shorter term ones, such as the put call ratio, 10-day average, or the percentage bulls. And even something as crazy, I know this probably sounds crazy, but in my time at SocGen, there, when the dollar made that big high up there in 2016, early 2017, The Economist came out with a headline that said the mighty dollar, right? Saying how strong it was strong as 10 man, we're never going to, wasn't going to come down, all these kinds of things. And I wrote a piece for the bank at that time. I thought I had it somewhere. And I just said that whenever you see a magazine, a headline like that on the front of it, like it had George Washington looking like he'd been to the gym for the last 4 years, pumped up on steroids, it was the picture. I said, whenever you see anything like that, it usually means that a market has run its race, right? So I said here, some of you may have heard of the magazine cover indicator, which states that a financial market makes it on the cover of a magazine, that the trend of that market has usually been enforced long enough to suggest it's near a major reversal. Sometimes that cover coincides with an immediate top, other times within a month. Then I wrote, I think it's a bit early at the moment, but within a month you'll see a high. And it was like maybe 3 and a bit weeks after that, that is the high that we've seen in the US dollar in recent times. So even silly things like that, you might think it's silly, right? But just things like that, they're always worth having a look on because they're good sentiment readers, right? Good sentiment indicators. And really, that's what we're trading, I think, in the markets. I'm sure there are fundamentals and relationships between markets, but sentiment, I think, is just so important.
Do you think that sentiment indexes have changed or should be changed based on the different players in the market? Like, for instance, there's so many technical traders out there now, whether it be high frequency or different, it's a lot of technical parameters. So do you think that makes the indicators you look at more prevalent or less prevalent?
Okay, well, just before I answer that last question. So, in regards to the high frequency guys, obviously they're doing their thing, trading, they're like surfers surfing the shore break, right? And then these sentiment indicators are looking for something bigger picture than that. So I don't think the high frequency guys so much would affect it. CTA modeling probably would, but all these models are programmed by a human, so there's still that human influence in on it. But yeah, you definitely need to keep your eye out for markets slightly changing their characteristics. Nothing stays the same. That's the truth in everything, right? Whether it's whether it's like cities going from 2 million to 5 million people and that corner store turning into something else, things always change. So you definitely need to keep an eye on these indicators and how they're performing and not just think it's a set and forget.
Yeah, absolutely. All right. Well, thanks, Gary. That was a lot of really good information from Gary, talking about the different ways he looks at technical analysis and different indicators he uses. Definitely look for more of that in the chat from Gary and the signals he looks at. Gary's joining us from Australia, where it right now is 1 a.m., so I really appreciate you staying up late for us and taking a look at the markets with us.
Oh, well, this is my normal time, mate. I'm up. I'm in my office right now. I've got a bed in here. I set alarms.
I like
don't
it.
Get too many sleep.
A true trading warrior.
You have to be when you're on the other side of the world. I don't get too many signals in like my daytime. They tend to pick up from, say, Europe Open until 7 a.m.
Well, I'd like to talk to you about that another time, actually. Maybe the next time we talk about how the market, the way that you trade the markets based on the different time zones, because obviously the markets are 24 hours and, we trade the Asian markets, but it seems like, there's obviously the most liquidity now and kind of sets the tone for the next few time zones, or at least for the Asian time zone, things like that. But we'll talk about stuff like that next time. But thanks for joining us, Gary. We'll talk to you soon.
Okay, guys.
All right.
Catch you next time.